Welcome to the Hurst Cycles community. I'm trying a different style of video for these community videos. They're a little more casual and I'm going to be trying to keep the videos shorter. I'll be working mostly off the Hurst signals charts so that we're all on the same page when it comes to the analysis that we're looking at. Please let me know if you are enjoying this style of video or if you feel I could be doing the videos differently. In today's video, I'm going to take a look at the euro to US dollar, so let's take a look at that. So here is a chart of the euro to US dollar forex pair. This is the chart for today, the 20th of February 2020, a lot of twos in there. And as you can see on this chart, the euro to US dollar is now heading down into a trough of 54-month magnitude. There's the circle for the 54-month cycle. Now, we made a change to this analysis, I think it was yesterday or maybe the day before. And so if you look back at the charts from a few days ago, you will see that, in fact, the euro US dollar was considered to be descending into a cycle of only 20-week magnitude, not of 54-month magnitude. So what has happened? Well, what has happened is that we've made a change to the analysis. And usually when we make a change to the analysis, there is a message up here at the top of the chart indicating that a recent analysis change has affected the FLD sequence. As a matter of interest, that message did not appear on your euro to US dollar charts, and the reason for that is because that the analysis change that we made didn't in fact affect the sequence of interactions between price and the FLD. That sequence is still exactly the same, and so because the sequence is unaffected, the analysis change doesn't, you aren't alerted to the analysis change because it doesn't really change very much. The reason why there was no change to the sequence of interactions between price and the FLD is because the 80-day cycle, the current 80-day cycle that we are seeing play out, the 80-day cycle trough was not moved. And so the current 80-day cycle has not changed in any way. The only thing that has changed is the expectation of the magnitude of the trough that we are descending into. And that, of course, changes your underlying trend, as you can see here. The underlying trend for the next trade that we are looking for in this market is, of course, an A category trade, and it will have an underlying trend of +5. Now, the system is indicating that the next trade is expected to be a G category trade, but that is because it hasn't really been able to pick up a clear GH category combination, although in my opinion that is probably what happened over here in the first week of February. That was in fact the GH. So the system is struggling to identify the G and H category interaction. So that's why it is still warning that that GH category is coming next. But it does indicate that we should consider an early A category trade. In fact, it wouldn't be a very early A category trade because, as you can see, there have already been 82 bars that have played out since the previous 80-day cycle trough. And so the only reason it considers it an early A category trade is because it hasn't been able to successfully identify the GH category interactions. So all things told, the next trade that I think that we are looking for here is indeed the A category trade. And you can see that the composite model line is indicating that, of course, the market is expected to rise upwards. We have to be very careful getting into an A category trade, particularly if this is a 54-month cycle trough that is forming, because it's a really big magnitude trough, so we need to be a little bit careful. And of course, you probably know by now that I often miss A category trades and wait for price to come back and catch it on that rebound. But let's discuss for a moment why we are looking at a 54-month cycle trough instead of the 20-week cycle trough. What happened? Well, let's take a look at the overview chart. Here is the overview chart, and I must shout out to Greg, who I think had been emailing us about the euro to US dollar a few times and suggested that I make a video about the euro to US dollar. And in fact, that email came in at just about exactly the time that we were looking at this chart and we were wondering whether we should influence the analysis a little bit. So here is the overview. Of course, the previous 54-month cycle trough occurred, is that early 2015, I think. This analysis only goes up to 54 months. It's not going up to the 9-year cycle at the moment, and the reason for that is because the arrangement of the 9-year cycles and the magnitude of the relative troughs isn't convincing enough, so the software won't position a long cycle trough if it's not absolutely convinced. And we're not forcing it because in terms of what we need here, we don't really need to be getting terribly worried about the position of the 9-year cycle trough. But you should be aware that it is certainly possible that this trough that we're coming down into now is not only a 54-month cycle trough, but it could be a much longer cycle trough. Those cycles have not been included in this analysis, as you can see at the bottom right of the chart. So what did we do? Well, first of all, there is the pin. When we make any pinning on the Hurst signals charts, we leave the pin symbols displayed on the chart so that you can see what we've done. Because you might disagree. You might say, well, I don't think that's really correct. Where was that 18-month cycle trough? It was, in fact, over here. Now, that was an example of a perfectly straddled trough, and so that wasn't necessarily an entirely incorrect position for the 18-month cycle trough. But the reason that we moved it, the reason that we pinned the 18-month cycle trough to this particular trough over here, is because of the recent very sharp, hard fall downwards. The system was considering that this trough here was a trough of the 54-month cycle trough, and therefore it was tracking the first 20-week cycle out of that. And as I mentioned a little bit earlier, it was expecting price to come down into the 20-week cycle trough. When price started coming down harder than expected, we had to sit up and we had to say, well, is this really the 54-month cycle trough? And let me zoom in here because I would like to make a point about the way in which this happens. There we go. So I've zoomed in now on that chart. Okay, and so this trough here was where the software was thinking the 54-month cycle trough occurred, and it was tracking a nice M-shaped 20-week cycle. However, if this was the 54-month cycle trough, then of course it would expect the first 20-week cycle trough to occur at a higher level. As prices drop down below the level of this trough over here, we have to question the magnitude of this trough. Now, this is what I love about Hurst cycles. They're a very robust process. Many people get very disconcerted because they feel that it's a huge thing that we've moved the 54-month cycle trough forward by 20 weeks. Well, some people... Well, is it really? The thing is that we've been trading this 20-week cycle, and so far the interactions between price and the FLD have been fairly good and reliable. Even if price was coming down into a 20-week cycle trough, we were in a short F category trade. We were trading short. The fact that it turned out to be such a big move and went down so much lower didn't mean that we were wrong in the trading that we were performing. All it meant is that our expectations were exceeded. And so I enjoy that about Hurst cycles. It means that you are usually trading in the right direction, but you are sometimes surprised by the magnitude. So what that might mean is that you're expecting a really big move for the bounce out of the 54-month cycle trough, but you are disappointed. You're not wrong. There will be some kind of a move, but you might be disappointed by that move if it turns out not to have been a 54-month cycle trough. Okay, so that is the situation at the moment, in my opinion, that we are heading down into a 54-month cycle trough. It might be an even bigger trough. It could be a 9-year cycle trough. We'd have to look at more data and start discussing that. In terms of what we're looking at in Hurst signals, it doesn't really matter whether it's 54 months or 9 years. It doesn't matter particularly. But we certainly need to be aware of the fact that because price is coming down into a really steep trough, you need to be a little careful of standing in front of a moving train, and so certainly I'm going to be just a little bit cautious. Of course, we would expect price to bounce out of the 54-month cycle trough with some strength. But if you are feeling aggressive and you feel it really is time for this trough to form, then of course you would enter at the level of the 20-day FLD. I'd be inclined personally, this is my trading style, I would wait for it to cross that FLD, hopefully in a good strong move. And I don't panic because I've missed the opportunity. If this is a 54-month cycle trough that is forming, then we're going to have a lot of upwards movement following it. So I'm not worried about jumping in and getting in right at the bottom. I think one of the mistakes many people make with Hurst cycles is they try to perfect their timing, and they try to catch the trough. Catching the trough is a dangerous game to play. I prefer to wait until there is evidence that the trough has formed, and then get in when the market comes for a bit of a pullback. There are the levels of the FLD for today, the levels to be watching. And of course, each day as the emails come out and the charts get updated,